Hello friends, welcome to the video. In this video, I am going to discuss with you interest rate risk. Interest rate risk is one of the key risks that need to be managed when you are working in Treasury. The reason is that banks make huge investment in fixed income securities. Even the securities which are held to maturity may have interest rate risk. I am not talking about securities which are available for sale or securities which are under the fair value through profit and loss, right? uh, the held to maturity securities also face reinvestment risk, right? Because coupons that you get may not be reinvested at the same rate which is the rate of coupon. So interest rate risk actually is a very interesting aspect of market risk that we need to understand, and that is what I will take you through in this video. So interest rate risk arises from changes in interest rate that can impact banks' earnings and market value of its assets and liabilities. So there is an impact on the investment book as well as on the liabilities and assets in broader terms. For instance, on one side, an increase in interest rate may lead to higher borrowing cost, affecting profitability. On the other side, interest rate increase may lead to lower valuation of bonds, loan portfolio of the bank, right? So you have impact that can be felt like this. An interest rate decrease may lead to lower interest rate receipts and thus lower profitability on floating rate bonds, loan portfolio of the banks, right? So if there is an interest rate fall that is happening, that also may impact the bank's performance. Banks often use various kinds of hedging strategies such as interest rate swap, forward rate agreement, bond forward, interest rate futures, interest rate options to mitigate this risk. However, in this video, I'm not going to discuss about the risk mitigation. So, what exactly are the details of interest rate risk? So, we can split interest rate risk into five categories: repricing risk, basis risk, um, yield curve risk, option or call risk, and reinvestment risk. So, these are the five risks which I will discuss with you in this video. What do they mean and how do they impact the performance of a bank? Repricing risk arises from mismatch between timing of rate changes for assets and liabilities. So, if rate change for asset and liabilities are not happening simultaneously, right? Um, then there can be a repricing risk, okay, leading to fluctuation in net interest income. Okay, let us see how does this happen. So in India, a bank may have issued long-term home loans at fixed interest rate, but funded these loans through short-term deposits that mature in 1 or 2 years. Now, this is an asset liability mismatch, but this is also causing a repricing risk. If deposit rates increase due to RBI's monetary tightening, the bank's cost of funding rises, but its loan income remains fixed, which will reduce what we call as the profitability of the bank. Right? This is what we call as repricing risk. So, what are the key drivers? Differences in maturity periods of assets and liabilities, central bank rate changes affecting funding cost, and interest rate change due to demand and supply factors in the economy. So this is what we call as the repricing risk. Now, next risk which we have is the basis risk. What is the meaning of basis risk? Basis risk occurs when interest rates on correlated financial instruments or liabilities change by different magnitude. Okay. This leads to a mismatch between return and cost impacting profitability. We have again one example. Suppose a bank have loans linked to MCLR while its liabilities are linked to repo rate. If that is the situation, okay, and if repo rate changes faster than MCLR, the cost of fund rises, but the loan interest income adjusts more slowly, creating a loss. So basis risk, unlike repricing risk, is not based on maturity. It is based on the benchmark. So if your assets and liabilities are linked to different benchmarks and they do not change uniformly, then you will have basis risk. Okay. Now, this may happen because of various reasons. Regulatory reasons could be also a reason, but otherwise also the bank may have decided to link its assets and liabilities to different benchmarks. What is an yield curve risk? Yield curve risk arises when the shape of yield curve changes, affecting the valuation of interest sensitive assets and liabilities. Okay. So what happens is during the period of economic uncertainty, the yield curve can flatten or invert. Now we will see what does it mean. But let me give you an example. Okay, for instance, long-term bonds may offer yield similar to one-year short-term bond, reducing return for banks holding longer-term investments. Right. So during COVID pandemic, RBI reduced repo rate, leading to a steepening yield curve. Banks holding longer-term bonds profited from falling yields. Right. So yield curve risk arises, and it can have following shapes. There can be a parallel shift in the yield curve, okay, which means yield across maturities are rising or falling by the same rate. Then you can have non-parallel shift, which is what we call as flattening and steepening of yield curve. So this is an example of yield curve flattening, okay, which means yield has become same across maturities. Initially, this was the yield curve, but this is the new yield curve, and there could be a steepening of yield curve, which may also have impact on the profitability of the bank, right? So the yield curve risk arises predominantly because of the behavior of the yield curve in terms of whether it is flat, whether it has steepened, or whether it has shown a parallel shift. That is very important for all of us to know. Now, there can also be call risk. What is the meaning of call risk? When companies issue bonds, sometimes there is a call feature attached to that. So, because of the call feature, the issuer may withdraw the loan or the bond earlier than its maturity. Now, if a bank has invested in such bonds, it will face what is called as the call risk, which can also be in a way called as an option risk. Of course, option risk has other aspects to it also. So, option risk arises from the use of interest rate derivatives that may contain embedded options such as callable bond or prepayable bond. These bonds give borrowers or investors certain rights that can affect cash flow unpredictably. Okay. So if interest rates decline significantly, borrower may choose to refinance their loans at lower rate, leading to a reduced cash flow, which is what I discussed with you. Now there could be a reinvestment risk. Why will reinvestment risk arise? The reinvestment risk arises when you cannot invest the coupon that you have received from the issuer at the same rate, which is the rate of coupon. So because of change in the market interest rate, you can only invest at a lower rate than coupon rate. So this will cause what we call as the reinvestment risk. Okay, reinvestment risk occurs when an investor is unable to reinvest cash flow from an investment at the same rate as the original investment. This often happens when a bond matures or is called before its maturity, forcing investor to reinvest at a potentially lower prevailing rate. So, what is the impact of interest rate risk for a bank? There is an impact on net interest income, which may fall. Economic value of equity may change, which means this is nothing but long-term impact on assets and liabilities valuation. Then we have investment portfolio, which may change, where you have invested in bonds typically, and customer behavior also can influence because when interest rate tend to go higher, many investors prefer to prepay their loans. What is the key metric that we can use? One, we can use economic value of equity. This metric measures theoretical change in net present value of a bank's balance sheet, excluding equity. So it reflects how change in the interest rate affect the overall value of the bank's equity under various stress scenario. That is what we call as the economic value of equity. And then there could obviously be impact on the net interest income. Okay, so change in interest rates can significantly impact net interest income also. So a bank has to always do a trade-off between economic value of equity and net interest income. Okay, research indicates while these metrics are interconnected, optimizing one can result into negative impact on the other. Okay, so the bank has to ensure that economic value of equity and NII for it remains in a balance, and there is no adverse impact of it on the business performance of the bank. Now, what are the tools which we can use for measuring interest rate risk? We can use gap analysis, which means we can bucket the assets and liabilities into different and also investments into different maturities and see how they get impacted from interest rate change. We can use duration analysis. Duration basically helps us to measure the risk of a bond. I'm talking about modified duration here. We can also look at earnings at risk, which will help us to evaluate the short term impact. And we can also look at economic value of risk, which will have an impact on the long term value, right? So these measures help us to identify what is the interest rate risk that we have. I hope you could get good understanding of different types of interest rate risk, and this will help you to prepare for certified treasury professional exam. Thank you for your valuable time. Please do not forget to subscribe to my channel and like this video.